In this video, rather than taking a deep dive into one topic, I'm going to mention very quickly 6 things that I think are very important and which could have an outsized impact on the financial markets and the economy. The potential impact in some cases is positive, in some cases negative, and in others mixed. They are the very high wealth-to-income ratio in the United States, the lingering effects of the massive fiscal and monetary stimulus since 2020, quantitative tightening, the approaching Fed rate cuts, the yen carry trade, and the impact of protectionism on interest rates. This chart shows the wealth-to-income ratio. It is the net worth of American households divided by disposable personal income, so wealth to income. This wealth-to-income ratio is currently 776%. It is far above its long-term average of 550% going back to 1952. Earlier peaks of 620% in 2000 at the time of the NASDAQ bubble and 680% in 2007 at the time of the property bubble were followed by severe crashes. This suggests that any shock could send asset prices sharply lower. If asset prices do plunge, then consumption would be negatively impacted, and that could set off a recession. This wealth-to-income ratio has been high since 2014, but it became very much higher after 2020. Many people believe that the very low interest rates during most of the years since 2014 explained and justified the inflated asset prices. However, with the effective federal funds rate above 5.3%, interest rates are no longer low, but the asset prices remain exceptionally high relative to income. The extraordinary amount of fiscal and monetary stimulus beginning in March 2020 is the principal reason why asset prices are so out of line with their historical relationship with income. This stimulus was so enormous, it was almost on a warlike scale. The question is, how long will the stimulus that began in 2020 continue to put upward pressure on asset prices? Let's look first at the fiscal stimulus. U.S. government debt has surged by $12.5 trillion, or by 55% since 2019, from $22.7 trillion to $35.2 trillion this year. It jumped by 19% in 2020 alone. Now, monetary stimulus. From the end of 2019 to April 2022 at the peak, the Fed created $4.8 trillion, increasing the size of its balance sheet by 115%. The Fed created $2.9 trillion in just 3 months, March, April, and May 2020. When the stimulus checks were deposited, the level of bank deposits jumped radically by $4.1 trillion, or 37%, during the 2 years from March 2020 to April 2022. This was entirely unprecedented. And although they have contracted some due to quantitative tightening since then, since the peak, they are still 34% above where they were at the end of 2019. This unprecedented surge in liquidity has pushed up asset prices and boosted economic growth. How long it will continue to have a positive impact depends on how long quantitative tightening continues. From the peak in April 2022, the Fed has destroyed $1.7 trillion through quantitative tightening, shrinking its balance sheet by 20%. It's currently destroying about $60 billion a month through QT. That's $720 billion a year. Quantitative tightening is causing liquidity to tighten, but it's not tight yet. In fact, liquidity remains excessive, so excessive that the Fed has to pay interest on bank reserves and on reverse repurchase agreements